Welcome to the Deep Dive. Today, we're jumping headfirst into some pretty specialized financial analysis.
It's definitely a technical topic, yeah.
We have this expert methodology in front of us, and it's designed to solve, well, a really big challenge in automated trading.
Right. How to correctly calculate what's called sustainable trading capital, or CPK.
Exactly, CPK. Specifically for an algorithmic portfolio trading US 100 CFD contracts.
Contracts for difference on the NASDAQ Q100.
And our mission today feels pretty critical. We need to translate this methodology. I mean, it's full of acronyms, statistical modeling.
It can look quite dense at first glance.
Break it down into clear, simple components so you can understand what it truly takes for an algorithm trading a leveraged asset like the NASDAQ Q100.
To actually survive.
Right.
Not just, get started, but to survive long term.
Right. Survive, maybe even thrive eventually. We're looking way beyond just the broker's minimum deposit requirements here.
Oh, absolutely. That's fundamental. Forget the minimums for calculating survival capital.
The focus has to be entirely on long-term survival.
And that focus on survival is, well, it's non-negotiable, really, given the context here. This analysis is very explicit. It warns that trading CFDs carries an extremely high degree of financial risk.
Especially with leverage involved.
Precisely because of leverage. And we have to address the elephant in the room right away. The data from this specific provider is stark.
What does it say?
It says 65.00%, 65% of retail investors trading CFDs with them lose their capital.
Wow. That's sobering. It
Yeah.
really is. So the core principle, the axiom driving this whole calculation has to be this. Your capital requirements must be driven by conservative risk management.
Okay.
It's based on risk, not the broker's number.
Exactly. Specifically based on your defined maximum acceptable drawdown, your MPD, and absolutely not by whatever low minimum margin the broker sets.
Okay, right. That makes sense. So let's unpack this framework for survival then. We're defining sustainable trading capital, CPK. And this analysis breaks CPK down into three essential components. You can think of them as maybe three pillars supporting the account.
That's a good way to put it. Three distinct pillars.
Right. We have the initial margin, or IM, then the risk buffer, RB, and finally the operational reserve, OR.
IM, RB, and OR, those are the building blocks.
Now, before we dig into each one, we really have to hammer home the difference between that initial margin, the IM, and the full CPK. Because they sound similar, but they mean totally different things for, well, survival.
Crucial distinction.
Yes. So the initial margin, IM, that's purely the technical security deposit, right? It's just the minimum fee the broker needs to let you hold the position open.
Exactly. It's the entrance fee, the technical requirement, nothing more, nothing less.
And then you have this sustainable trading capital, CPK. That's the big one.
That's the whole picture, yes. The total financial reserve you actually need to survive the inevitable market volatility, the long sequences of losses.
Which will happen.
They absolutely will. CPK is what you need to endure that without the account blowing up.
So the core equation, CPK equals IM plus RB plus OR, it shows us where the money needs to be allocated.
Precisely. IM is the capital tied up in the open trade. That's the technical bit we just mentioned.
Okay.
RB, the risk buffer, does the heavy lifting. That's the capital specifically set aside to absorb the maximum expected portfolio drawdown. This is your real risk management money.
The safety net.
The safety net, exactly. And then OR, operational reserve, covers all the trading cost commission, swap fees, even potential slippage budgeted specifically to, keep the lights on during that whole drawdown and recovery phase.
Right, because costs don't stop just because you're losing trades.
They certainly do. Swap fees can accumulate quickly, especially if recovery takes months.
Okay, let's zero in on that first pillar then. Initial margin, IM. The source details the technical requirements from the broker under ESMA rules, European regulations, which caps leverage for index CFDs, like the US 100 we're talking about, at 1.20 for retail clients.
That's correct.
1 to 20 leverage means the initial margin required to open a position is only 5% of the contract's actual value, its nominal value.
So 5%, that sounds low.
It is low. It's a low technical barrier to entry. And that's the part that often misleads traders, I think.
How so?
Well, while that leverage dramatically reduces the initial margin needed, it absolutely does not reduce the overall risk you're taking on or the need for a really substantial risk buffer, the RB.
Okay, so this brings up that common misconception, right?
Yep,
The IM is so low, why can't someone with, say, $1,000 just start trading? Isn't that the appeal of leverage?
That is precisely the trap that, well, maybe contributes to that 65% loss statistic we mentioned.
Right. Leverage lets you open the position cheaply, yes. but it doesn't give you the financial cushion, the safety net, needed to withstand volatility or a string of losses.
Okay, so the low IM is almost deceptive. It can be if you don't understand the total capital required. And here's where algorithmic trading introduces a really crucial detail: the importance of micro lots, trading tiny position sizes like 0.01 lots. Okay, this is where it gets really interesting for algos.
Exactly. The availability of that minimum 0.01 lot size dramatically shrinks the dollar amount of the initial margin needed for a single trade.
Got an example?
Yeah, the analysis used the S&P 500. The IM for a sort of medium-sized 0.5 lot position was over $3,100, but for a tiny 0.01 micro lot, it dropped to just $62.45.
Huge difference in margin.
Huge difference. But the strategic reason this matters for algorithms isn't just about saving, $3,000 on margin for one trade.
What is it then?
Microlots are critical because they allow the algorithm to achieve extremely precise position sizing. Granularity.
Okay, precision. Why is that so important? That granularity is the technical key to enforcing the absolute #1 risk rule. Never risking more than, say, 1% of your total capital on any single trade. The 1% rule.
Right.
Without the ability to trade in tiny 0.01 increments, an account, especially a smaller or mid-sized one, simply couldn't stick to that 1% rule consistently. If your stop loss needs to be X pips away, but the smallest position size makes that risk 3% of your capital,
Then you're forced to either over-risk or just not take the trade.
Exactly. You break the rule or you miss the opportunity. Microlots solve that dilemma for algorithms, allowing strict risk adherence. Okay, so IM is just the entrance fee made more accessible by microlots, which enable proper risk sizing. That leads us naturally to the second pillar, the operational reserves, OR, the running costs.
Algorithms aren't free to run. There are transaction costs. So this OR capital is specifically allocated to cover the real costs of doing business. What kind of trading environment does this methodology recommend to keep those costs predictable? Predictability is absolutely key for modeling the OR. That's why the methodology strongly prefers or even requires using an ECN account type.
ECN, Electronic Communication Network, as opposed to, say, STP.
Right. ECN is preferred over standard or STP accounts mainly due to transparency, often better execution quality, and a predictable cost structure. You know what you're paying.
Okay, what are those predictable costs you need to model into the OR?
They're explicit. You have the commission. The analysis mentions $10 USD per standard lot traded for a standard status account, or it drops to $8 per lot for a prime status, maybe based on volume.
Right, a fixed commission per trade.
Exactly. Plus, ECN accounts typically offer very tight spreads, sometimes starting from just 0.3 pips on major indices like the US 100. But you still need to factor in that small spread cost and, critically, the swap fees for holding positions overnight.
Swap fees. Those can add up.
They really can, especially in certain interest rate environments or if trades last days or weeks. So the operational reserve needs to be robust enough. The calculation involves estimating your total monthly costs commission plus swap based on your expected trading volume.
Okay.
And then multiplying that monthly cost by an estimated time, you need your account to survive and recover from a significant drawdown.
How long are we talking?
The analysis suggests planning for a 3 to 6 month survival window just covered by the OR. So if your monthly costs are, say, $200, you'd want an OR of $600 to $1,200 at minimum.
Got it. Covering the bills while the account is potentially underwater.
Precisely. Okay, now we arrive at the real heavy hitter, the heart of this CPK calculation. The risk buffer, RB, the core component, yes.
This is the pillar designed purely to protect the account against the statistical reality of losing streaks, of serial losses. If IM is the entrance fee and OR is the running costs.
RB is the actual financial armor, the safety net.
Exactly.
And this is where we finally bring in your personal risk tolerance, your maximum acceptable drawdown, MPD.
Okay, explain the MPD again.
The MPD is the line in the sand you draw. It's the maximum percentage loss from your peak capital that you are willing to tolerate before you say stop, pull the plug on the strategy, or reevaluate everything.
So it's a personal decision.
Absolutely. One person might set it at 20%, another at 30%, but the risk buffer, the RB, must be calculated specifically to ensure that even if the market throws its worst, statistically probable curveball at your portfolio.
You don't cross that MPD line.
Exactly.
Yeah.
The RB keeps you above your maximum pain threshold.
But assessing that worst curveball, that sounds complex, especially when you have a portfolio of strategies, even if they're all trading the same thing, the US 100. It is complex, and this is where a critical, often overlooked factor comes in, the correlation matrix, represented by Correlation. Okay, why does this correlation matter so much more than just looking at, say, the biggest historical drawdown each individual strategy had on its own? Because it's the difference between real portfolio risk and just a simple sum of parts. Think about it. If you had 10 strategies trading 10 completely unrelated assets, maybe gold, Japanese yen, coffee futures, U.S. bonds, and the U.S. 100, they very different markets.
Right. A loss in your coffee strategy is unlikely to be related to a loss in your yen strategy. They're probably uncorrelated or have low correlation. A loss in one might even be offset by a gain somewhere else. That's diversification working.
Makes sense. However, in this specific case, all the strategies in the portfolio are trading the exact same index, U.S. 100.
Right.
All eggs in the NASDAQ basket, essentially.
Essentially, yes. Therefore, there's a very high likelihood of positive correlation between them, especially during major market moves.
Right.
Meaning that when the market experiences a systemic event, like a sudden tech sector sell-off affecting the whole NASDAQ queue, the losses from your individual US 100 strategies will not be diversified away.
They'll all lose together.
They'll likely all lose together, yes. Their losses will add up or potentially even multiply each other if they react similarly, increasing the overall portfolio drawdown dramatically, systemic risk.
So just adding up the worst loss each strategy ever had individually, the MHDD, doesn't capture this combined simultaneous hit.
Not even close. That simple summing method dramatically underestimates the real risk in a correlated portfolio.
So what you're really saying is that focusing on the low initial margin is almost a financial distraction from the real risk calculation.
It absolutely can be.
Which requires moving way beyond simple historical averages or individual strategy performance. Precisely. And that's why this methodology insists on using a more sophisticated technique, portfolio value at risk, or VAR. VAR. Heard of it? What does it do differently?
Portfolio VAR is an advanced statistical calculation. Its key strength here is that it specifically incorporates the correlation between the returns of all the strategies in your portfolio.
Okay, so it models how they move together.
Exactly. Based on that correlation, VAR estimates the maximum potential loss the entire portfolio is likely to experience over a specific time period at a certain confidence level. It gives you a much more realistic figure for the expected maximum portfolio drawdown, the PMDD, under stressful correlated market conditions.
Okay, that sounds much more robust. So applying this mathematically rigorous VAR approach, what does it actually mean for the size of the risk buffer? How much extra cushioning do you need compared to just, say, the biggest historical loss?
The recommendation from this analysis is quite conservative, and deliberately so. You must size the risk buffer, RB, at 1.5 to 2 times the expected maximum portfolio drawdown, PMDD, that you derive from that correlation-adjusted VAR analysis.
1.5 to 2 times the VAR drawdown estimate. Why the multiplier?
That multiplier acts as a buffer for the buffer, essentially. It's designed to cover tail risk, those rare but severe negative events that go beyond even what the standard VAR calculation predicts. Black swan events, or just worse than expected correlated downturns.
So insurance for the insurance.
Kind of, yes. For example, let's say your correlated VAR calculation tells you the expected maximum portfolio drawdown, PMDD, is 18% of your capital.
Okay.
The minimum risk buffer required, according to this methodology, should be 1.5 times that, which is 27% of your total capital.
So an 18% expected drawdown requires a 27% buffer.
At minimum, yes. That 27% buffer is what ensures survival through that predicted 18% hit, plus some extra room for unexpected nastiness. Compare that to a trader just relying on the tiny 5% initial margin.
They'd be wiped out multiple times over by that 18% drawdown, let alone the 27%.
Exactly. That's why CPK focuses on RB derived from correlated risk. Okay, wow. We've broken down all 3 pillars now. IM, OR, and the big one, RB. Let's try and synthesize this structure. If someone listening wants to apply this kind of framework, what are the key pieces of information they absolutely need to have or calculate, right? The inputs for the model. You absolutely need, first, your chosen maximum acceptable drawdown. MPD, that personal pain threshold.
Okay.
Second, you need the historical performance data for each individual strategy, including its maximum historical drawdown, MHDD, to feed into the correlation analysis.
MHDD for each strategy. Got it. Third, the crucial piece, the calculated correlation matrix, showing how all your strategies' returns interact with each other. This drives the VAR calculation, the correlation matrix. That sounds like the hardest part to get right.
It requires careful statistical analysis, yes. And fourth, you need a realistic estimate of your expected monthly trading volume to properly size the operational reserve, or R.
MPD, MHDDs, correlation matrix, and expected volume. Those are the keys.
Those are the essential inputs, yes.
Now, this whole architecture, It sounds like it requires constant attention. It's not like you just calculate CPK once, deposit the money, and walk away, right? It needs active risk control.
Absolutely not. It's dynamic. The methodology mandates constant active risk control built into the algorithms themselves.
Like what?
Primarily dynamic position sizing. The algorithms must constantly recalibrate their position size before every single trade to ensure that 1% risk rule, or whatever rule you set, is never violated based on the current account equity and stop-loss distance.
So the position size changes as the account balance changes.
Exactly. And critically, this means following the anti-martingale principle.
Anti-martingale.
Yeah.
Meaning the opposite of martingale, which is doubling down after losses.
Precisely. When capital decreases during a drawdown, the algorithms must reduce their position size proportionally. You cut risk when you're losing. Scaling up risk to try and recover losses faster, the martingale approach, is a guaranteed path to blowing up the account eventually.
Okay, so reduce risk during drawdowns. That makes sense.
It's crucial for survival.
Yeah.
Also, because the entire portfolio is concentrated in just one asset, the US 100 index, there's significant systemic risk exposure.
Right, the correlation risk we talked about.
Yes. So this methodology highly recommends implementing a hard maximum daily loss limit for the entire portfolio.
A daily circuit breaker, kind of.
Exactly. A hard floor, maybe 2% or 3% of capital per day. If that limit is hit, all trading stops for the day. It prevents one really bad day where all correlated strategies crash simultaneously from causing rapid, uncontrolled capital destruction.
A safety valve.
Yeah.
A vital one in a single asset portfolio. And there's one more layer of management. Regularly revisiting and recalibrating that correlation matrix. Why do correlations change?
They absolutely do. Market conditions, volatility regimes, geopolitical events, they can all change how seemingly similar strategies behave relative to each other.
Ah.
So if the analyst monitoring the portfolio sees that the correlation between strategies is suddenly increasing significantly,
Meaning they're starting to move even more in lockstep.
yes, increasing the systemic risk, the analyst must intervene immediately. That might mean proactively reducing the overall leverage or position sizing across the entire portfolio, or it might mean temporarily suspending specific strategies whose individual risk, when combined with the others in that heightened correlation environment, is multiplying the portfolio risk too much.
Wow, so it's really active management based on changing correlations.
It has to be. Sustainable trading, especially algorithmic trading, relies on this kind of constant risk control, not just setting initial parameters or maximizing leverage. Okay, so to bring it all back home then, the core message is sustainable trading requires defining your capital based on survival, which means focusing on that massive risk buffer derived from correlation analysis, the VAR-driven RB.
And absolutely not basing your funding decision on the broker's technical minimum, the initial margin.
That's the fundamental takeaway. IM is entry, CPK, driven by RB, is survival.
And then there's the final practical step you mentioned.
Yes, the real-world implementation. After all this complex calculation, the VAR modeling, the buffer sizing, you'll likely end up with your required CPK amount in a major currency, probably US dollars or euros, since we're talking US 100.
Right.
But your broker account might need to be funded or collateralized in a different currency, perhaps Czech koruna, CZK as mentioned in the source, or British pounds or Japanese yen.
Okay, so currency conversion.
Yes. You need to convert that analytically derived CPK amount into your required account currency. And the recommendation is to use the current exchange rate, or perhaps even a slightly conservative rate, to account for potential currency fluctuations. It's that final step that connects all the analysis to the practical reality of funding your trading account safely.
It grounds the whole complex model in operational reality.
Exactly.
All right. That was a really deep dive into calculating sustainable capital. So maybe we should leave our listeners with this provocative thought to mull over, maybe explore on their own.
Okay.
If that statistic is right, and 65% of retail traders lose money trading CFDs, how much of that widespread failure do you think is due to people simply grossly underestimating this systemic correlation risk we spent so much time on? You know, having all their eggs in one highly correlated basket, like multiple strategies on the same index, without realizing how those risks multiply together, as opposed to just blaming individual strategy failures.
That's a very interesting question. How much is hidden correlation risk versus just bad strategy?
Yeah. Something for you to chew on until the next time we dive deep.